Everyone tells you the same thing your entire career. Save more, defer your taxes, max out your 401k, put it off until later. And you did. You built something real. But here's what nobody talks about. What happens when you want to stop working before 59 and a half? The accounts you spent decades filling up have a gate on them. Touch them before the magic birthday and you're hit with a 10% penalty on top of ordinary income taxes. So you keep working. You wait. But that's not the full story. I'm Megan Ramshaw, Certified Financial Planner at MOKAN Wealth. In this video, I want to shift the conversation from saving and deferring to something nobody talks about enough: spending flexibility and after-tax income. Two specific moves that can open the door to early retirement, legitimately without penalties. Let's get into it. The financial industry is built around accumulation. Save more, defer more, grow the number on the statement. That advice got you here, but it's only half the story. The half nobody talks about: how do you actually spend that money in a tax-efficient way once you're ready to stop working? For most millionaires in 401k and IRAs, almost everything is locked in pre-tax accounts. Every dollar you touch is ordinary income. Every withdrawal is a taxable event. What that advice misses is flexibility. Having money across different account types, pre-tax, Roth, and taxable, lets you control what shows up on your tax return each year. It lets you spend what you need without being pushed into a higher tax bracket or losing your healthcare subsidy. The two moves in this video are how you build that flexibility. When people think about retiring at 55, 56, or 57, the first question is, do I have enough saved? That's the right question, but not the hardest one. The harder question: how do you pull income in a tax-efficient way for the 5 to 10 years before Social Security and Medicare start? Social Security kicks in at 62 at the earliest. Medicare starts at 65. That's a gap where you need income. You're covering your own health insurance, and every dollar pulled from the wrong account at the wrong time costs more than it needs to. The people who retire early and keep more of their money aren't just good savers. They're good tax planners. They built an income bridge that controls the tax hit year by year. If you leave your employer through retirement, resignation, or layoff, during or after the calendar year you turn 55, you can take withdrawals from that employer's 401k without the 10% early withdrawal penalty. You'll still owe ordinary income tax, but the penalty is gone. One detail that trips people up: it's based on the calendar year, not your birthday. Retiring in March 2026 with a September 55th birthday, you still qualify. A few things to know: this only applies to your current employer's plan, not IRAs, not old 401ks from previous jobs. If you roll that money into an IRA before you need it, you lose that exception. Timing matters. Your plan also needs to allow flexible withdrawals. Some plans only allow lump sum distributions, which creates a large, unnecessary tax hit in 1 year. Check your plan documents first. The right way to use this isn't to pull a large lump sum. The best retirement plans use pro rata withdrawals, some from pre-tax, some from Roth, some from taxable, creating tax diversification and allowing you to generate the income you need while selling the fewest shares possible. We see this all the time. A household comes into us at 54, ready to retire within the next 2 to 3 years. Most of their wealth is sitting in one pre-tax bucket. The first conversation we have isn't about saving more, it's about shifting the strategy. Stop deferring everything. Start restructuring spending. That means pulling back on pre-tax contributions, building tax diversification across account types, and creating a withdrawal structure that gives you flexibility from day one of retirement. Not just a larger 401k balance and a single lever to pull from. The households that get this right before they retire have far more control over what their tax return looks like in retirement. The ones who don't arrive with everything in one bucket end up paying more than they need to for the first several years. The rule of 55 funds your early retirement years without penalty, but it's all pre-tax money. Every dollar is taxable income. That's where the second move comes in. This is where the conversation about after-tax income really starts. The financial industry spends so much time on deferring taxes that it forgets to ask, what does your after-tax income actually look like in retirement? If everything is pre-tax, every dollar you spend is a taxable event. Every withdrawal bumps your income. The mega backdoor Roth is how you build the tax-free side of retirement. at a scale the standard Roth IRA can't match. In 2026, the total 401k contribution limit across all sources is $72,000. Your employee deferral is $24,500. You contribute after-tax dollars to fill that space, then convert to Roth, either through an in-plan conversion or an in-service withdrawal to a Roth IRA. The result, tens of thousands of dollars per year moving into a tax-free bucket, growing tax-free, and coming out tax-free in retirement. 2 requirements. Your plan must allow after-tax contributions and either in-plan Roth conversions or in-service withdrawals. Confirm this with HR before building your strategy around it. If your plan allows it and you're still working, this is one of the highest leverage moves available. You're building after-tax income now, so you have real flexibility in retirement, not just a larger pre-tax account that Uncle Sam gets to share. 2 spouses, both 54. One is ready to stop working, one has another year or 2 left. Together, they have $2.4 million, most of it in pre-tax 401k accounts, a smaller brokerage account, and very little in Roth. This is a hypothetical example for illustration purposes. This is exactly where the save and defer approach has created a tax blind spot. Almost all of their wealth is in one bucket. The spouse still working executes the mega backdoor Roth for 1 to 2 years, converting $30,000 to $47,500 per year into Roth while they still have plan access to do it. The spouse who retires separates from service in the calendar year they turn 55. They use the rule of 55 to withdraw $80,000 to $90,000 annually from the 401k, staying within a controlled tax bracket and funding their lifestyle without penalty. Over 5 years, this couple builds meaningful tax-free assets, funds their lifestyle today, and uses the lower income years before Social Security starts to manage their tax picture deliberately, rather than letting it pile up into a larger RMD at 75. By the time they hit 60, they can pull from their Roth when it makes sense, pull from the IRA when it makes sense, and control what shows up on their tax return in a way that's simply not possible when everything sits in one pre-tax bucket. That's the difference between a save and defer strategy and a tax-first retirement plan. 3 things determine whether this works. Plan rules. Not every 401k supports the mega backdoor Roth. Not every plan administrator processes Rule of 55 withdrawals flexibly. Know what your specific plan allows before you build a timeline around it. Bracket management. The Rule of 55 gives you access. It doesn't make your withdrawals tax smart on its own. Over-withdrawing in a single year can bump your income, trigger IRMA surcharges down the road, or eliminate your ACA subsidy before Medicare starts. Access is only valuable when the withdrawals are coordinated. These strategies require someone to watch income, taxes, account balances, Social Security timing, and healthcare costs together, and adjust as life changes. A small planning error held over 10 years becomes a large and unnecessary tax bill. The financial industry has spent decades telling you to save more, defer more, and worry about spending later. That discipline built your wealth. But the conversation has to change. Retiring early isn't just about having enough saved. It's about having money in the right places with the flexibility to spend it without handing an unnecessary portion to Uncle Sam. The Rule of 55 and the Mega Backdoor Roth give you spending flexibility, after-tax income, and control over your tax bill, starting well before 59 and a half. If you want to see how these moves fit your specific situation, click the link in the description to talk to our team. We'll look at what you've built and put together a tax-first plan built around the retirement you're actually planning for, not a generic number from a spreadsheet. See you in the next one.